Good afternoon and welcome to this episode of Nucleus Investment Insights. Has bank lending shuddered to a halt with Professor Steve Keen? We are a little bit late, so I thank you all for those who are logged in live for bearing with us as we get up and running. So by now you know the stats on the interest rate rises we've seen in Australia. We've had 12 in 15 months, combined with a stubbornly low unemployment rate confirmed just this morning at 3.5 again for June. But amongst the media reporting of this were also headlines about job cuts at Telstra and Coles Group seeing the number of applicants per role almost doubled from what it was 12 months ago, albeit back to maybe what might be more normal levels. So what can lending tell us about the economic picture in Australia? Professor Steve Keen joins us to find out. So through his work in popular books such as Debunking Economics and Can We Avoid Another Financial Crisis, along with his weekly podcast through his Patreon page, Professor Steve Keen strives to educate the world of the failings of neoclassical economics and highlight the risks of the insatiable drive for more debt in modern society. Professor Steve Keen, welcome back to Nucleus Investment Insights. My apologies.
Good to be here. That's greetings to Sydney at the middle of the day from Amsterdam at the middle of the night.
Thank you for joining us at such an unusual time for you.
I'll survive, yeah.
And here to go through our thoughts on how bank lending might be incorporated into our portfolios, we're joined by Nucleus Wealth's Chief Investment Officer, Damien Klassen.
Hi, Shelley. Hi, Steve.
And I'm Shelley George. Sorry,
yeah.
Steve.
Okay, George. Okay.
Yeah, Chief Operating Officer at Nucleus Wealth, coming to you today from the lands of Gadigal people of the Eora Nation. And I'd just like to remind everyone before we get into the meat of the show that the information on this podcast is general in nature and it's not going to take into account necessarily your personal situation. So if you did want to discuss anything about your personal financial situation, you can go to our website, nucleuswealth.com/contact, and book a call in with our senior financial advisor, Samuel Kerr, to have a no obligation chat. So on that note, Damien, I'll hand it over to you.
Yeah, thanks. So, look, the reason for getting Steve back on is we've seen we saw a number of sort of ructions go through the US banking system earlier on this year, and we've seen quite a marked slowdown in credit in a number of areas over the last not just because of that sort of helped to bring us another leg down, but the credit was already slowing due to higher interest rates. And Steve's a bit of an expert in the idea of money creation and this idea that I guess we really have been driven by debt and I guess given the slowdowns, what I'm most interested in is trying to work out where the stall speed is and whether that's an issue, and I guess how he's seeing it in terms of that. So I might maybe I could first start, Steve, with the US sort of Silicon Valley Bank and those types of what you saw coming out of that, and I guess the slowdown in US regional bank lending.
Well, I mean, it's a crazy time for the world economy. There's no point in starting a podcast without saying everything is going pretty crazy all around. And obviously the major element that's defined the last 4 years, whether you believe in it or not, whether you think it's a conspiracy or not, is COVID. And the initial reaction of governments to COVID was one that I applauded with one hand. In that I said they should be doing a larger fiscal response, because the last thing you wanted to do is have people going bankrupt because they weren't allowed to go to work. And that was everybody. The tenants couldn't pay the rent, landlords couldn't pay the mortgage, etc., etc. You would have had a complete financial breakdown. Now, the governments were still terrified about inflation, which we got to, but that's a later story. So they did a lesser amount than they should have done. But still, when you look at the American stimulus, and for quite a large proportion of the population, the stimulus that they got was larger than their normal wage check. So you had an enormous boost to cash in people's hands, because when the government runs a deficit, the non-government part of the economy runs an identical surplus. That is just a law of accounting. And it's one that neoclassical economists don't understand because they haven't got a clue about balance sheets and how they really work. But that's what actually happens. You had an enormous financial stimulus. That, of course, led to property bubbles, because people were then not being able to spend on consumer goods. An obvious choice was to get back into the property market again. So that happened globally. And that did take me by surprise, I've got to say, because I just thought, Please, no more bubble, but that happened. And then in the aftermath, we now have the inflation that's occurred and central banks putting up interest rates around the world dramatically. But that's got two effects. The one that I normally focus upon is the impact that has upon borrowers who are therefore facing higher borrowing costs, are unlikely to go ahead, and you'll have a credit crunch. And that's what seems to be finally developing now. But in for government bonds, what that means is bonds that used to yield, when they were sold, yield 1% and 2%, are now yielding 5%, 4% and 5%. So there's actually quite a substantial income flow to people who are bond owners or bond buyers directly from the government, however they get hold of the direct auctions or secondary market and so on. So you have a fiscal stimulus still going on for most economies. The American economy deficit is still running at about of the order of 8 to 10% of GDP, which is quite a strong stimulus. You have the rates have gone up, but of course in America most rates are fixed. So there's been a delayed impact upon credit in that sense, but I think it's still going to come through. So I'd still be expecting a credit hiccup, not the I don't know what should I use the word fart for what happened in 2008, but something less obscene than what happened in 2008, but still a credit-induced slowdown. That's more likely to come Australia's way early because of course, the prevalence of floating interest rates in the Australian system. So the interest rate effect flows through in terms of putting up domestic non-government rates.
Yeah, and so actually, and just to define for our users, so that's just that Australia has generally fixed rates. US, you take out a mortgage and it's generally 30 years, and you're fixed for 30 years. Whereas Australia, you're lucky if you can get 5 years. Most people end up taking a variable. And I guess the other side is the companies tend to be similar, and you're somewhere 3 to 7 years in terms of company debt, and so company debt does sort of 20 or 30% of it rolls off every year in terms of companies needing to refinance at higher rates.
Yeah. So that's there's differences nationally around and internationally around the world, but a common theme for most countries is first of all, the impact of rising bond rates on new bond purchases, which is positive, but for Silicon Valley Bank, and this is the point that I focused on when it first happened, negative because it destroys the value of existing bonds. And we've never had that before. Certainly on the scale we've got now, the interest rate, this is one of the fastest increases interest rates in terms of where we started from, going from 1% to 5%, roughly 500% increase. Okay, we've had changes from 10% to 15% beforehand, which same scale, but it's a 30% increase, not a 500% increase. So the impact that has upon long dated bonds is drastic. And if you make just to illustrate this, I did a simulation in my Minsky software of imagining all bonds are consoles, and consoles are therefore infinitely dated, so they're directly inversely valued related to the interest rate. So a couple of interest rate rises would, with the consoles, would have driven the entire banking sector into negative equity. And negative equity means bankruptcy, which is not what you want for the financial sector. So I think we're using conventional tools in a very unconventional environment and paying a large price for it.
Yeah, but is it fair to say though as well that Silicon Valley Bank was not a traditional bank in and some of these others as well, in terms of rather than getting out and lending to people with it, they were actually investing a lot of their money in government bonds, and it was almost a bit of a trading issue, that a trading mismatch. So traditionally, when you start seeing bank problems, it's because the people you've lent the money to can't pay the money back anymore, and you start defaulting on the loans. Whereas this was more of as I said, almost a trading issue in terms of the way they structured their book.
Yeah, but the funny thing is, if you looked at their books and said, well, how would you rate this bank? Is it conservative or radical? And conservative meaning cautious, okay? You'd say it's conservative, because rather than lending, it really did operate as a deposit bank for Silicon Valley corporations. And if you think about the banking regulations the States has, that I think it's what protects deposits up to $250,000. Is that correct?
Yep.
I think so. Yep. That's a lot of money for an individual. That's chicken feed for a company. So the regulations don't suit the type of banking that Silicon Valley was doing, which was fundamentally being, like a savings bank for Silicon Valley. I really found it quite ridiculous when I looked at it. That just doesn't sound like what I thought of coming out of Silicon Valley. But that was the main way they were selling themselves: the services to the depositors, rather than being a lending machine, which is what the standard bubble banks in America behave like, and in the dot-com bubble. So being conservative was dangerous because of the increase in interest rates, and that's not normal. If you were being conservative bank at the time of Vockler and not lending out much money, then you saw the value of your bonds rise as interest rates fell.
Yes. Okay.
This time round, your bonds collapses because the rates rise, and you're screwed because you're being conservative.
Yeah. Okay. So, and in that sense, it's sort of unlikely that that's going to spread then to the rest of the banking sector. But the question about, I guess, the bigger question is, if you get a slowdown in credit, and then you start actually getting real credit problems coming out of this, then and I guess, do you have a view on that and sort of timing and I guess what your thoughts are?
Well, one of the great problems is the data for this is always massively delayed. It's always behind schedule. So I use the Bank of International Settlements database, and that's like a 3-month or 6-month lag on actual debt numbers. So I can't say what's happening right now. I should be, if I had a data team behind me, I might be looking at the lending data coming out of the Federal Reserve and things like that, which gives you advance warning of which way credit is going. But if you take a look at credit in America right now, and I can actually do that live if you like with my Ravel software, that would be, if you're going to share the screen, if you were showing.
Probably, Shelley.
Give it a try.
Yeah.
Okay, let's share the screen, entire screen. Now there's going to be a bit of fun here with the disappearing window effect. Can you see my screen? Okay, part of this is the beta version of software I hope to release commercially next year, and there's a couple of little hassles that occur. So for some reason it's lost its time formatting here. So, oh great, STOI, that's an unrecoverable error, so I can't fix that up. Dates look dreadful, pardon the fact they've got this T00 going on there, but this is the level of private debt in America, the red line. The black line is government debt, the one that the neoclassicals obsess about. You can see they both had a big spike during COVID and then fell back down again. But if you look at credit, which is the annual change in debt.
In terms of that, sorry, that spike we can see, and actually, Shelley, I can't actually see that coming through on the live yet. How much of that? Oh yeah, I've got it. Sorry, yep, it's coming through now. How much of that do you think is because GDP fell as opposed to debt rising?
Yeah. That happened. That's true. There was a plunge in GDP as well. So the ratio changed more than the actual amount of money. There was a substantial increase in fiat money creation. Let's drag this over here. I defined fiat as the annual change in private debt, and you can see the spike there. The numbers is that's 25% of GDP.
Yes.
So the scale of government spending.
And sorry, and that data goes back to 1940. I think I could see there. So yes,
goes back to 1940. So nothing of this scale has happened since the Second World War. Certainly, and I can see even the Great Depression, the scale of this. The Second World War is the only event where the deficit has been as a similar scale to was it during COVID.
Yeah.
No. So you see that. And this is the point that mainstream economists are useless on money. So what they're ignoring, Sorry?
And sorry, and I guess that's what I'm coming back to on some of these on those charts to the left as well. Is it's is some of that is it's overstated because of the fall in GDP, but it also means that the because you sort of look at that initially, like you might look at that chart and go, oh well, actually we've just things have got way better. Yes, okay, that things were bad, but actually look how fast things got better, and maybe that'll keep happening. Maybe that trend will keep happening, but actually you're probably better off even just getting rid of that little blip, aren't you? And just sort of like, if you just sort of line through it, we're still on the rising trend. I guess if you got rid of that blip because you went the denominator fell away dramatically and then bounced back, and so it made it look as if it's high, but yeah, we're still the actual levels of increasing.
There are two elements to it. There was a larger, even though you take into account the fall in GDP, so the denominator falls, the numerator rise was still there and quite substantial. Not as big as it made it look like the fall in GDP, but still there. And what you've got therefore is a dramatic level of government money creation, which got us through the crisis. Without that, I think we would have had bank failures galore. If we just let it as a private sector system, if you had the level of private debt people are carrying these days, of the order of 170% of GDP for most economies, if you have that occurring, without people being able to, not getting a salary because they weren't able to go to work, not making a profit because their coffee shops were shut down, etc., you would have had wide-scale bankruptcies and the wiping out of the financial system. So you had to do something, and what the government did was the right thing. maybe kicking and screaming, drag towards doing it by events rather than thinking ahead, but it did happen. But that, of course, set us up for all the other elements that have come through on the financial system since.
Mm. And one of those, one of the other things they did was basically, suspended the rules for bankruptcies and insolvencies, and most of the globe.
And they had to do that.
Yeah, most of the globe, you could trade insolvent and do all those types of things. And it seems to me that meant that we went through, I don't know, 2 or 3 years of like never seen before so low bankruptcies. And now we've sort of accelerated as they sort of all kicked on last year, sort of late last year. Most of them sort of rolled off around the world. And we've sort of accelerated from those low points back up to average and maybe even a little bit through the average at the moment. But I guess this trajectory is, are you seeing, do you think this is just a return to normal, and actually it's going to take another while before we start to see those bankruptcies really start to impact on economies? Or is this something imminent? I guess what's the sort of, and is that line going to keep going up to sort of overshoot, I guess, on the other side, and get a bit of payback?
To use a football analogy, we're going to have plenty of own goals in the crisis what coming our way. So the first own goal is damaging the value of government bonds by putting up rates and not being aware of the impact that has on the solvency of the financial system. That's number one. Number two, central banks have because they're staffed by neoclassical economists, they have no concept of the impact of credit on aggregate demand. That it's not globally. There are some who've got a brain on that front. So Michael Kumoff of the Central Bank of the Bank of England understands it, and there are a handful of people in different banks who've got some awareness of that. But generally speaking, if you do a neoclassical economics degree, it tells you credit has no role in aggregate demand. So you're not worried about whether you put rates up and reduce the number of borrowers and savers, because you simply see it being like a seesaw. You transfer spending power from the borrower to the saver when lending is going up, and vice versa when it's going down. No overall impact on credit. That's absolutely wrong. Credit, because we live in a world in which banks create money by loans, and nobody borrows for the sheer pleasure of being in debt. Government lending by private banks, which is credit, boosts aggregate demand dollar for dollar.
Yeah,
so
and actually,
if
maybe
you have a
just for people who haven't sort of heard this before as well, just to maybe I could summarize it and see if I get it right. From the perspective is that so I want to go and build myself a house, and I haven't got a loan, and so then I go, yep, I'm going to go and take a loan out from the bank, and the bank goes, yeah, thanks, Damien. Yep, you meet the criteria. Here's $600,000, and then they simultaneously create a loan on one side of $600,000 that I now owe them, and stick $600,000 into my account, and they've created that money brand new. Now I go and give that to my builder, and then he goes and disperses it all over the place, and that's new money that's been created, as opposed to have I got that right in terms of that's what traditional economists don't look at that.
Yeah, and they've got this idea. The reason they don't is because the reason they gave the Nobel Prize to Bernanke last year, which is probably the greatest joke, one of the greatest jokes in the history of the economics Nobel Prizes, he promulgates a model called the loanable funds model of lending. And what that says is Steve learns to Shelley, and therefore Steve's got less spending power and Shelley's got more. Then Shelley pays him back, and Steve's got more and Shelley's got less, and it cancels out. And if that was the real world, then credit would play no role in aggregate demand. But because we live in a world in which banks create money by creating loans, then that accounting doesn't work out. And I've done the mathematics. It's absolutely provable that credit is part of aggregate demand and aggregate income. But as you mentioned with your example, it doesn't just stop at goods markets. It goes to asset markets as well. So we have to combine the asset markets and the goods market to get a feeling of what the credit dynamics are overall. But credit is crucially part of demand. So if they trash credit at some point, then we'll have a recession. But credit is still positive and rising, which I might go back and show my screen again, if that's okay. I want to show that bottom chart.
Yeah.
So let's see, entire screen. We're going to have the same old fun with the disappearing infinite screen there, but this is credit. I'll bring that chart up so you can see it front and center. And that's from 1940 through to, that's 2023 data there. And what you have, there's the financial crisis. So we had credit hitting 15% of GDP, going to -5%, which is the first time it fell below zero in the entire post-war period. That's why the downturn was so severe in the 2008 crisis. But we've come out of there, and you can, and this massive volatility up and down credit being hit by COVID at this particular point. But at the moment, it's back up to sort of average levels for the post-war period. My expectation is that as the higher interest rates feed through into people's borrowing, given the level of debt they're carrying, which of course is far higher here than it was back there, then we're going to see this head down and go towards the negative again. But I'm not expecting a crisis on the scale of 2008, because to have a crisis that big, you've got to have a big bubble beforehand. And we haven't, we've got high levels of debt, which has stopped that bubble actually taking place. So we're not going to fall from as high a level of credit as we did last time around. But it's still, the mechanics are there for the Federal Reserve to stuff things up again by provoking a decline in credit demand and the economic activity turning down, and they can't understand why.
Yeah. Yes. And where do you think because so some of the more recent data, and as I said, it's not fully out yet. Some of the more recent data, sort of post Silicon Valley Bank, sort of points towards a relatively sharp slowdown. Certainly not into negative territory or anything. But I guess in sort of broad picture sense, where do you think the stall speed is? So in terms of it being that, I feel as if there's enough debt out there, and we're reliant upon this debt for growth, that if we fall below, it's not necessarily going negative that actually sparks it. It might actually just be a low positive where we're just not generating enough growth.
It's a combination of two things. This is why what's called modern monetary theory is worth people understanding, because when it's applied just to domestic economy, it's basically accounting. And what it tells you is that there's two ways you can create money. Banks create money by lending more than they get back in repayments, and the government creates money by spending more than it gets back in taxation. Now you have governments obsessed with running surpluses, which actually means they're taking money out of the private sector. If they continue going in that direction, you're going to have low to negative fiat money creation. They won't get to negative because the economy would start falling over before they got there. But that reduces the greater growth of monetary demand. And then credit is the other thing. The credit engine, if the interest rate gets too high and borrowers aren't willing to consider going into debt and banks aren't willing to consider lending, then you have low monetary growth from both credit and government money creation, and that will feed through to the overall economy. So I don't see a crash, but I can see a bit of stagnation in the economy coming out of all this.
Yep. So maybe the two of the bigger places that where I guess that there may be debt issues. Commercial real estate in the US, I guess, is one of the key ones that most people are sort of highlighting as to where there could be an accident. I guess your thoughts on commercial real estate and partly that's driven by the work from home, obviously. But,
yeah, well, that's a huge factor. I mean, we've never had that happen before, and a lot of people complained about working from home, but quite a few thought this is actually damn good too. So you have a massive overvaluation of the existing real estate, courtesy of that. That's a classic exogenous shock, by the way. That's probably the first time something has come along which you can say the up and down in the economy is caused by what economists think the ups and downs are always caused by, which is something coming in from outside the economy, exogenous shock. So yeah, it's dubious as to how they'll ever get back to the level of valuation, because the real estate commercial valuation depends upon occupancy rates, and if you've now had a huge hit to occupancy, then it's going to be a sluggish sector, even if it's not going to be a sector that has a crash. And if you're highly geared with sluggish revenue, then you could be in trouble.
Yep. The other one that I find very interesting, and I'll tell you, is the Chinese property market. And I'll give you my take, my initial take, and I'd be interested to see your thoughts on it. Is that I look through the Chinese developers, and the top 20 developers are actually pretty similar. Like although you go, yes, there's obviously some that are worse than others. They're actually all pretty much in a similar boat. In that, if you look at their sales, they owe about half their sales, their annual sales, they owe in just payables to either their own staff or contractors and all that type of stuff. So basically they haven't paid people for 6 months, so they've taken out a big chunk of debt effectively from their suppliers. Then you look and they go, they've got like 2 or 3 years worth of inventory sitting on their books they haven't sold. And then you look and they go, actually, they've also got on the flip side, on top of that, they've actually got a year and a half's worth of money they've taken in from people to build stuff that they haven't yet built. So they've sort of borrowed from borrowed from those people. And then you go, when you look debt to equity, they're about, for every dollar of equity, they've got about $10 worth of debt. And so, you know, under no circumstances, like any one of those individually, you'd be like, maybe I shouldn't give money to this company. But so I guess what I'm getting to with that is the whole sector looks, you know, completely uninvestable, but the central bank is basically saying, okay, we're going to keep providing you money so you can build the stuff that people have already paid for. And I guess where I'm looking at from that is saying, well, it's almost like they're a utility now. It's basically they're basically saying, okay, we're gonna keep these things alive that probably should die, with just enough debt to keep them going, so they can build the stuff for people that's already paid for. Because if these things fell over, you know, that's the whole economy is probably gone, and potentially the Communist Party with them. So and so I guess I'm sort of interested in your thoughts in terms of, you know, it's almost like a force-fed debt now, and what that means in terms of the Chinese economy. You know, is it just a slow sort of sink away without the chance of a crisis, or is there or is there a crisis factor that I'm missing here somewhere, or is there an upside that I'm missing to that?
Oh, there's a whole lot of stuff you can miss when looking at China. I might actually go back to sharing my screen again with another file that doesn't have the same bug issue that I showed with the last one I just used. And again, quickly, because I want to show the Chinese data here. So pardon me for the crazy effect here. And then, boom, can you see my screen now?
That looks a bit better.
Okay. So that's because this is China's private debt level, and you can see that it actually exploded during the financial crisis. There's 2007 there. So the beginning of the financial crisis occurred. The data is displaced here for the bottom chart. Again, this is all beta software. So you see that actually is starting here. So the two zeros don't overlap. But there's the increase in credit that occurred during the financial crisis, a 40% increase from levels averaging about 12%, never getting beyond 25, hitting 40% of GDP. And that's what started the property bubble in China. Now that's we all know the huge overbuilding both of commercial and residential real estate in China, and to some extent the Chinese Communist Party is now committed to that, because so many people have bought properties as an investment that if there's a clash in asset value, then you can get some pretty interesting riots happening outside government offices in China, and certainly bank offices. And they're now stabilizing at a level of private debt which is actually higher than the Western world. So if you go back to the pre-crisis level, there's private debt at about 120% of GDP. At the same time, America was 170%. Okay?
And sorry,
Japan was 225.
In private, this is households plus corporates, or is it just
households plus corporates? Households plus corporates. I could break it down, but it's households plus corporates.
Okay,
mainly corporates. I think.
Does that include much of the state-owned entities in the corporates, or is that separated?
That's data put together by the Bank of International Settlements. So that's a question you have to ask them rather than me. I think the most likely is, it's hard to assemble the whole data, but the basic intent is huge credit-based stimulus in 2008, 2010 is what pulled China out of the downturn being caused by the global financial crisis hitting their exports.
And Australia as well. As they did.
And Australia as well. We benefited from that too. Yeah. Then what you've got is this huge overhang of debt. But the thing is, of course, most of the banks are either owned by the Communist Party or controlled by the Communist Party, in the sense that when the Communist Party tells you to do something, you say yes, sir. Okay, you don't debate whether you own it or not.
If they say you're lending to this property company so they can finish, you don't go in there and say no, but they've already got too much debt, and they're not paying their bills to their suppliers, and they've got all this other quasi debt that's all over the place. You just go yes.
And the other thing is the central, because the government, there's so much more control of the monetary system in China than the Western world, even though they let it go crazy to get themselves through the global financial crisis. Effectively, it's possible for the Chinese government to do what you mentioned the Americans and so did recently, waive bankruptcy rules and stuff like that, let you operate insolvently, etc., etc. So if a credit crunch in China can be addressed very directly, because effectively the government runs the private sector as well, not completely, but much more powerful and influence than we've got today in the West. So I expect to see disturbances, but China can just basically go in and write that debt off. And it's a question of whether they do it effectively or not. But they've got, because they have the ownership of the financial sector or the control of the financial sector, they can get out of it in the ways we can't do in the West.
Yeah. Okay. So I guess am I right then in saying that an acute crisis seems unlikely? It's more likely to be just a long period of slow growth.
Well, that's one, like, that's not the reason I'm focusing on climate change and the economics of that these days. But I think fundamentally that's going to overwhelm everything else. When that starts hitting, you can throw everything else you worry about out the window. So to me, in that sense, COVID was a trial run for what's going to come our way with climate change, and of course we failed that with flying colours. So I'm not exactly holding out hope about how we're going to manage what will hit us through disturbances from climate change.
Damien,
well, okay, so
a quick break before we jump into
that? Sure. Yep, okay, sounds good. Very
good.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
All right, we're back. We have one question, but maybe do you want to do climate change first? Which order, Damien?
Yeah, let's go to climate change. So, Steve, you've got a paper out. I think, is it today? It's being released, or is it?
No. Snafus next week. So okay. I've finished it. And it'll be talking about how economists, if you think they got the financial crisis one, you ain't seen nothing yet about what they've done on climate change.
Okay, so yeah, well, do you want to give us the big picture on that?
Okay. But William Nordhaus, the economist, got the Nobel Prize for his work on climate change in 2018. For various reasons, I hadn't, it's part of neoclassical economics, I hadn't attacked earlier in debunking economics, but I finally had a look at it after he got the prize, and I've never seen such nonsense. I mean, I'm a critic of mainstream economics, but at least I'm criticizing theoretical absurdities. He uses empirical absurdities. So in his first estimate of the published estimate of the economic impact from climate change, he said that 3 degrees of warming would reduce future GDP, which is going to therefore be growing over time, by no more than 0.25% compared to what it would be in the complete absence of climate change. Yeah, Shelley, I agree totally with your facial reactions there, literally. And the reason was, he said, because most of the GDP is generated by enterprises that take place in carefully controlled environments that will be negligibly affected by climate change. Now, to give you an idea of how carefully he's put that out, he classified 87% of American GDP as taking place in carefully controlled environments, which would not be affected by global warming. And that included mining.
Right.
He sort of neglected the fact that there's open cut mining, which therefore is exposed to the weather, which is what he's identified climate change as. So the only sectors thought to be affected by climate change, those without a roof. And that is so childishly stupid that it should never have been published in anything other than a kindergarten draft, which hopefully the parents would take home and feed to the dog afterwards. Instead, they gave him a Nobel Prize for him. So
why
the
was
standards,
it published?
why
was it published more broadly?
Because neoclassical economists, and there's a long ideological explanation here, that if you become a neoclassical economist, you basically end up believing capitalism can cope with anything. Therefore, nothing can be a threat.
Oh, okay.
Okay. And like I've had plenty of conversations with mainstream economists saying, oh, look, if it's warmer, I'll just wear one less cardigan during winter. You think, you bloody lunatic, you shouldn't be allowed near anything where science is involved. But that's what they've done. So people thought, and I thought this before I read their papers, I thought they'd taken estimates of physical damages to things like crops, obviously, but also manufacturing facilities, et cetera, by scientists, and then discounted that and got a low damage coming out of that. And that's not what they've made up their own numbers, and they made up their own numbers on completely spurious grounds. So they've assumed, first of all, anything with a roof won't be affected. So they've just done damages to agriculture and forestry, largely, and that's what they get their estimates from, as though the rest of the economy will sail through unscathed. And they've then assumed that they can use the current relationship between temperature and GDP to predict what's going to happen when temperature rises over time. Now, that's juvenile.
So, sorry, what do you mean by that? So in a cold country, you get less GDP, and a warm country, you get more GDP, or vice versa?
They started off in America using what they call the Ricardian approach to working out damages, and they said, well, what's happened geographically is the people have optimized what they do in production in different regions. Okay, so we can take the current distribution of economic activity across America as being representative of what it would be at different temperature levels as temperature rises over time. Right. Now, there's absolutely no correlation between geographic impact of climate, where there's the same level of energy in the biosphere, and you're just changing where you are on the surface of the planet to have different temperature and rainfall effects. That's got nothing to do with what happens as you raise the overall temperature of the planet. But they will proudly argue that, well, whatever, if you can't prove that something happens over space, in other words, temperature doesn't matter geographically, then you can't prove it matters over time as well. Now, that's juvenile.
Right. So effectively, we were just saying, let's give San Francisco LA's economy, because everything gets a bit warmer and you push everything up, and we'll give Portland San Francisco's economy,
That's basically it. So what I've done this just as a joke myself. So you can get data on gross state product in America and average temperature, and then I've done a scatter plot of the two, and it's a scatter plot like a child has thrown the family porridge at the TV screen. There's some sort of pattern there, but it's pretty hard to work it out. They fit that with a quadratic, y equals x squared, saying the impact of temperature depends on the temperature difference squared. And I fitted that to data, and I got a damage function twice as big as Nordhaus's out of that. So it is just ludicrous to say that like a 10-degree increase in temperature will cause about a 15% fall in GDP, because there's effectively 10 degrees difference between New York and Florida. And if you went up 10 degrees, you go from New York's income to Florida's income. They'll try to say it's more fancy than that. That's fundamentally what they've done. Their numbers are nonsense. And that because most people trust them and think they're experts, the political class and the media in general has think, climate change isn't all that much of a worry. Look, it's only going to cause the next percent fall in GDP. That X is going to be X to the power of X when it actually hits.
Yeah, and I wonder though, and maybe there's partly a comment for you, Shelley, is why published is, I guess if you in a sense, Stephen, I think there's the part we go, I want an answer that says I shouldn't have to worry about this. Can you find me an economist who will deliver me that answer, and then we'll promote their work. Yeah.
Right. So I have another question. Obviously, we've been talking about the piece uses as a base idea, this idea of different average temperatures in areas. But it seems to me that one of the key concerns from climate change is the instability in temperatures and natural, I guess, disasters. So it sounds like they've obviously excluded that from the analysis. Is that right, Steve?
Effectively. I mean, what I thought I'd have to do when I decided to go and apply my usual critical eye to this part of neoclassical economics, I thought I'd be explaining why a Ramsey growth model is the wrong framework for long-term damage estimates, and technical, and why the discount rate should be negative rather than positive, etc., etc. But I haven't even got there, because they're stupid assumptions. You just look at them and think, you're a moron. I mean, you're an intelligent moron. You're, as once was said of economic education, you're an idiot savant. You've been trained to handle complicated mathematical techniques, but you don't realise your underlying logic has no connection to the real world. So my favourite example there is a recent paper, 2021, by a guy led by a guy called Dietz, at the London School of Economics, I think, where they said that losing 8 major elements of the climate would cause a 1.4% fall in future GDP. Now, those 8 elements are the Arctic summer sea ice, Greenland, West Antarctic, the Amazon basin, what's called the AMOC, the effectively people think is the Gulf Stream, keeps Europe warm, the Indian monsoon, ocean methane hydrates, and permafrost. All of those 8 being triggered would reduce GDP by 1.4% compared to what they would be in the complete absence of climate change. That, by the way, is at an average temperature 6 degrees higher than at the moment.
How much is it going to reduce the human population by?
Exactly.
Like,
I mean,
how much extra is everyone who's left going to be spending?
Yeah, I know, and we've already seen, we're seeing already that we're about 1.25 degrees above average right now, about the pre-industrial average, and we're already seeing, news about people are worried about Texas, as a potential location where you could have a failure of the power system, failure of air conditioning, temperatures people can't recover from, and large deaths through to what's called the wet bulb temperature catastrophe in Texas. That's 1.5. You try 6. Okay. So the number of people who are going to die because of this is what's making me so angry, because the financial crisis just wiped out people's financial futures. This is going to wipe out their lives.
Yes. Okay. So.
Cheerful me.
Yeah, that's right. That's good way to finish. That's well, actually, and I think there's obviously that point. Is there anything else on that paper? I suppose. What else do you want to talk about with the paper?
Well, I mean, there's a lot in it. So it's coming out from Carbon Tracker. It should be released next Wednesday. So that's the current expectation when it's going to be out. Freely available. Please take a look. We're focusing on what it means for people's pensions, because, of course, pension funds have taken this because it's refereed publications. They think refereed means high quality. Work must be okay. The consultants have then taken that on board and then told pension funds, for example, UniSuper, which is my superannuation fund, sent me a document saying that 2 degrees warming would be overall the best situation for my portfolio. 2 degrees of warming would increase annual returns by 0.05%.
Yes.
Now, that's one reason why. Why there's no action being taken on climate change? The reason is because politicians, their advisors, journalists, economists, of course, is the source of all this nonsense, have swallowed this stuff and basically it describes the future accurately. And therefore, that's the future they're preparing for, where literally 2 degrees of warming will make things better. Now, what we're going to get is total climate chaos. We're already seeing the beginning of it. This year is off the scale. If you're following any of the indicators for temperature levels around the planet, then it's scary as hell. And the people who scare me more than me are the ones who know more than I do about the data. And that's particularly terrifying.
Yeah. Well, and I think there's obviously some stuff we saw from last year that I think people wouldn't have expected in terms of the all these nuclear power plants offline in Europe in the middle of a massive energy crisis, because they'd be putting out water that would start killing the fish because the water's too warm. The average water temperature in the rivers, and so there's just stuff like that that's not even thought about within these models. Obviously, this
is the major problem. We're energy blind. I mean, here I am with the light. It's 5 o'clock in the morning in Amsterdam. We just take it for granted, turn and flick a switch, and you've got electric power and light. We are energy blind. We're simply not aware of these. We're dependent upon energy and how it's formed, and then the fragilities that exist. So the nuclear power stations had to be shut down because global warming meant there's been a fall in rainfall patterns, so the rivers didn't have enough water. They couldn't cool the water sufficiently for the plants to operate. So at the time you need more nuclear power, you had less. Now, of course, the same problem applies to coal-fired power stations. They've got to cool their water as well. So we may well face with rising temperatures. It becomes impossible to get the temperature, to get the performance you like out of the energy sector. And well, therefore burning more fossil fuels to try to make up for the failure of the existing resources. So we're in this sheer and utter chaos, and coming largely because economists don't understand energy in particular, but fundamentally they don't understand the economy either.
Yes. Okay. Well, that's probably an even happier note to say that we've got to finish up on. Shelley, I might back to you for
another quick break. All right.
Yep.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
And we're back. All right, so let's jump into questions. We've got one here from Peter. How does the world get out of this debt bubble without crashing the world economy?
The easiest way for governments to implement what I call a modern debt jubilee, which is basically say, look, we made a mistake. We let the private financial sector rip and create too much private debt, too much credit. We need to cancel that debt without crashing. No, you want to bring asset prices down, frankly, but you don't want to bring it down so you wipe out people's equity. So the proposal I put forward is to use the government's capacity to create money to give everybody an equal amount of money. And if you have debt, you've got to pay the debt down. If you don't, you get either a cash injection or you get government bonds, depending on whether you want to stimulate the economy or not. And that would then reduce the level of private debt dramatically. And it also has the impact, when I model it, of increasing economic activity, because you're effectively putting more money in the hands of workers to spend more money. Because the vast majority of people who got that cash would be workers, not capitalists, just because there are more workers than capitalists.
Yeah.
So hence you'd have a stimulus to the economy, and you
Well-
therefore, as well as reducing the debt burden directly, you'd also reduce it indirectly over time through more economic activity. That may look a bit passé, since I say that climate change is going to bring that to an end, but it would be relatively simple for a government to do it. And when we look back at history, the ancient civilizations had regular debt jubilees, and they were frankly more aware about debt than we are. And we should be doing a similar thing and making the level of private debt one of the control mechanisms in the economy, which at the moment, because it isn't, that's one of the reasons we've got into this pickle.
Yes, and then that does raise. And do you think that creates moral hazard though, in terms of it being?
No, well,
I've just taken a big loan out, and let me go again.
That's one of the reasons I came up with the idea of a modern debt jubilee, because when I first proposed this back in 2006 or thereabouts, or 2007, somebody said, "Well, what about moral hazard? If you only paid the debtors off, and you reward the people who speculated, you don't reward the ones who stayed out of the speculative bubble."
Right.
So I said, "Okay, make it to everybody." And then you have this idea that those who don't have debt get a cash injection. So the thing is, it doesn't actually benefit you to be geared. You want to take away the benefit of gearing. At the moment, in the corporate sector, because you can deduct interest payments, but you don't deduct equity payments, then we have a bias in favor of debt finance rather than equity finance there. In the household sector, because you're using debt to buy housing, which is driving up housing prices, etc., you get a positive feedback on the level of debt you take on in the household sector as well. And household debt is now 5 times what it was per capita from, say, 30 years ago. And of course, we're talking interest rates that are now comparable to what they were in the late 60s, early 70s. So the debt level's 5 times what it was. The rates are the same. That's not a healthy situation. So because we made a mistake of ignoring debt, we have to bring it down, and that would be a mechanism to do it. And also, certainly there'd be dangers. Things could go wrong. You'd want to, do test runs, small amounts of it, and see what actually happened, and then modify the policy afterwards. But fundamentally, we have a mechanism by which we could reduce private debt. Private debt is a problem, not government debt. We should use that mechanism and stop worrying about a will-o'-the-wisp, which is the government debt issue, and focus on the real issue, which is private debt.
Yeah. Excellent. Shelley?
That's it. We don't have any other questions at this point in time. So,
Okay.
Damien, is there anything else you want to chat about, or should we ask Steve where we can find out more from him?
Yeah, that sounds good.
Steve.
Okay. Well, So my two places to locate. I'll just do the same story again, and pardon the the craziness when we suddenly see the disappearing windows. So I have 2 websites people can follow me through. One is Patreon, and that's my Patreon site there, patreon.com/Prof Steve Keen. And the other is Substack. The content
for the episode. Sorry, we'll grab that URL for everyone. Anyone who's on the podcast and can't see it, we will make sure that's in the notes for the episode. Thanks, Steve.
And the other is Substack. That's profstevekeen.substack.com. I mean, the mainstream universities are never going to produce a new economics. They're going to continue regurgitating the same old thing. So if you want a non-orthodox approach, you have to get public support for people like myself who are trying to build a realistic economics. And it's not going to come out of Harvard or Princeton, to mention 2 places I've lectured at just recently.
Why is that, Steve?
Because you have a paradigm, a way of thinking about the world which dominates any intellectual profession. And economics has this neoclassical paradigm which came out of the 1870s. Basically, it's a reaction to Marx. And it describes a perfect mechanical system, reaches equilibrium, you get paid what you're worth, etc., etc. It's a very seductive, effectively cult-like vision of an anarchist a libertarian society where there's no control, no force, etc., etc. And that has a deep ideological appeal to people who get into it. So the economists, they're trying to promulgate it and push it forward. Only when you take a step back and say, hang on a sec, that doesn't sound like it describes the real world properly. This particular feature worries me. And then people who make that, and I'm one of those people who did it, obviously, goes out and take a look and think, you're all a bunch of raving loonies. This doesn't describe the real world at all. You've got an intricate, elaborate mathematical model that has fallen over numerous times. You've ignored the mathematical errors that's been involved there because you like the vision. So you simply can't shift that paradigm. In a genuine science, anomalies would come along that would disturb the paradigm and force change. Anomalies do happen in economics, of course. The global financial crisis wasn't supposed to happen, according to the mainstream. But rather than saying, oh, we've got an anomaly we can't explain, you go on to the next problem. You forget about the Great Depression, you forget about the Great Recession, go on to the next issue. You can always find students who find the underlying system appealing, whereas in genuine sciences, once you have an anomaly, it's there for the students to reproduce at any time, even if the professors try to avoid it. The students know about it. When the professor has to retire, they're replaced by somebody who accepts the new paradigm. That process doesn't work in economics.
So, I mean, it's so confusing. I can't understand where the vested interests are around it, because when I did economics, which was a while ago, there was genuine
Not as long as me.
acknowledgement that it wasn't working then, and we've made a few sort of steps towards behavioral economics, but you've obviously talked today about the serious issues that underpin it, and has such a capacity to affect everyday lives of people, maybe more so than some of the sciences. So I don't know.
Yeah, it desperately matters that it's realistic. But the trouble is the whole history of economics has been political. And like if you go back to Adam Smith, his argument was pro-capitalist and anti-feudal. We forget that going about a quarter of a millennium, the dominant political system was still largely feudalism, which we're coming out of all the restrictions of feudalism. And Smith's argument was anti those controls and pro merchants, etc., etc. Then Marx, because this then led to the Industrial Revolution at the same time. So the enclosure movements and peasants becoming workers and the horrible situation in 19th century Europe. My picture for 19th century Europe is mid 20th century India. Okay, pollution levels. Karl Marx and Jenny Marx moved out of Chelsea in London because of a cholera epidemic. Okay, so we don't tend to have the historical context anymore to know just how bad the situation was there. That led to the calls for socialism. Marx used the classical school to be an argument against capitalism and pro-socialism, and that's when what's called neoclassical economics took over in the academy. And I haven't analysed that carefully myself, but a lot of it's got to be, because those people are politically favourable. But once it's there, it's the people who push this stuff, and these are my fellow economists, most of them are nice people. They're not doing it for the money. They do it because they believe in it. My favorite example of that was I set up a guy from the what's called the Productivity Commission. He didn't realize this, but he spoke in front of employers and unions for the food processing industry, and they ripped shreds off him, and he was in total shock. And then we had at a bar later. I sat down, just feeling sorry for the guy, and he finally said to me, "Look, you're an economist. Help me convert these people."
So it's a belief system. Yes.
Right, I see. Okay. All right. Oh dear.
Yeah.
Well.
Had a few late questions, Shelley.
Oh, great. Okay. You've got them in front of you?
Yeah, sure. Bright Light, Distant Star is asking, how do we start to lobby for change, and where do we start?
Politically, the main thing is to get people to be aware that in terms of the current political issue which matters, getting the people aware that government debt is not a problem. The private debt's the problem. That's the major issue to do. On that front, what's called modern monetary theory when it's applied just looking at what the government does, is the best possible development that's happened since Keynes, because we've finally got a non-orthodox theory being pushed forward in the public in a way that hasn't happened since Keynes. Yeah. And they basically say, look, government debt is your asset. Okay? If the government goes into has a liability to you by having negative equity, that creates your positive equity, dollar for dollar. This is how fiat currency operates. So if we know that, we'd have more freedom to do things with government money than being told we've got to shut down schools because we don't have the money to educate people. Well, that's a double whammy that comes back and bites you twice.
So look, I've got a lot of sympathy for the concepts of modern monetary policy applied properly, but what I worry about is that what's the lesson that a lot of people have learned in inverted commas from the latest thing is that modern monetary policy. Yeah, we tried something like that at the pandemic, caused all this inflation. See, we told you it would cause inflation. Never try that ever again.
Yeah. I mean, the inflation is almost, in most countries in the world, it's already ended because the major source of it was supply side, the impact of COVID on supply chains, and the impact of rising energy costs on production. So the idea that interest rates, that the government stimulus did play a role, and that's because when you decompose the factors that cause inflation using the non-orthodox approach that I take, you bring it down to three major factors: the markup that firms impose, the cost of production, and the amount being paid to workers. Now, the amount being paid to workers was positive for a short while in the early part of the crisis. This is the same thing applied in the 70s. But fundamentally, the inflation has come from rising markup and falling productivity. That's where they've come from. Now,
so can I actually ask before you go on? Would it have receded without any intervention from central banks on interest rates?
Yes, it would have. Okay. But the main thing is the government spending did play a role, because one thing that restrains the markups is what the person who developed this theory, a guy called Mikhail Kalecki, called the degree of competition. Now, that's not how many firms you have; it's how much competitive pressure manufacturers feel. Because if you're really pumping out cars, and your sales are being affected by the marketing, your Daimler, your Ford, and your marketing of GM is affecting your sales, then you'll be restrained. But if you have the level of monetary demand that occurred because of the fiscal stimulus during COVID itself, stuff is just going out the warehouse. So you think we can put prices up? Okay. So the government stimulus did make the room for markups to increase. But that meant your form of inflation was different to what the theory tells you, which says, it's workers' wage demands. Workers' wage demands have been below the rate of inflation for pretty much the duration of the crisis. So the idea of putting up interest rates to crush demand out of the economy is a pretty primitive way to do it. You would be rather trying to get firms to reduce their markups, which will happen gradually anyway as they feel more competitive pressure with less demand in the economy. So definitely the government spending did play a role, but the real cause was firms reacting to that by putting up their markups.
Yes, we've dealt with that a few times on this one. And the other interesting one. So Chris Dobby is asking, what other ways have we got to get the workers' population of the economy increased? Which is sort of, I guess, flowing exactly back to that you're speaking about there in terms of, if companies are putting up their wages, putting up their profit shares, then they're obviously getting a larger slice of what's coming through.
Yeah, I mean, the major cause of instability from capitalism for the last 50 years has been letting the finance sector get too big. Okay, huge levels of private debt. That actually, when I mathematically model that in my complex systems approach to economics, rising private debt, even if the borrowings are done by firms, not by households, rising private debt causes falling workers' share. So the increasing debt levels are being paid for by the working class, not by the capitalists, and that's a huge part of the. If you go back to the 50s and 60s, before we let debt get out of control, you had what was called the golden age of capitalism. There was not a large level of debt, large turnover of existing money. As the debt levels risen, the rate of turnover of money has fallen because people are thinking, I've got to hang on to the money that I need to pay my debt down. So there's less spending coming out of that, less spending out of cash. And when people do that, they don't actually create more money. They just reduce GDP. So all these factors have meant that when we changed over from the 50s and 60s, which was fundamentally old style Keynesian, don't worry about government deficits, keep the banks under control, don't let them lend too much. There was a huge economic activity from turnover of existing cash. That's gone. And now instead, if you're going to get extra demand, it comes out of credit. So that's a huge reason why a major factor has to be to try to reduce the level of private debt to back to what was in the 50s and 60s and not let it get out of control again, which would mean a finance sector about 1/2 to 1/3 the size that it is now.
Yes. Yeah, I think I spoke to you about this last time, is that I quite like the GDP version of the economy where the finance sector is treated as a negative rather than as positive. And
Yeah,
so it's
fundamentally,
basically saying,
it's
you're not adding anything,
it's a cost of production. Yeah, it's not a profit center. This is the mistake we made, treating it like a profit center. So that's put the cost of business dramatically, and burden people who shouldn't be thinking about this. They should be thinking about the kids, not the value of the house and what their shares are worth. So we have a distorted world coming out of that, and that's partly where the neuroticism of the modern world emanates from.
Yeah. Excellent. Thank you very much. That was that's great.
What a great show. Thank you. All right. So
You're welcome.
To listeners, well, actually, yes, first, Steve, thank you so much for making the show. Really enjoyed it.
Thank you. By the way, one thing I better mention. You may see some annoying ads coming out with my name attached to them about a free cartoon book and maybe a set of courses. They're actually genuine with marketing. It's still waking up that's not the way you market to my buyers. So I'm giving a set of courses on economics, 16 lectures for $500 US, which you'll find in a roundabout way using that system. I'm trying to get them to improve their marketing right now. That's another way to get in touch and also to support my work.
Okay. So can you give us the link to give to listeners in the show notes for that, Steve?
Yep, I'll do that. It's embarrassing in some ways, but let's hope they improve the marketing as time goes on.
Fingers crossed.
Okay.
All right. So for listeners, if you enjoy our content at Nucleus Wealth, please subscribe to the YouTube channel, like the video and click the bell to be notified if we have any special episodes or future content coming your way. Also, if you know anyone who might get value out of today's episode, we would really appreciate you sharing it with them, maybe a friend, a family member, or a colleague. So for myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching today, and we look forward to seeing you at the next one. Bye for now.